the exact level that separates Bullish Hopium from Capitulation to Bearadise. Hey guys, it's Keith Allen, and we've got some price action that is definitely worth a conversation today. My goodness, I've actually been trying to get to this analysis for 2 days, and I keep saying I got to do these earlier, because I write the whole thing out, I get it all set, I look at charts, I write it out, I get it set to go, and then things play out, right? So it's not played out yet, but a lot of the things that I identified, as you're going to be able to see it, as you may deduct from reading some of my other content on X or in our Telegram community, has kind of been developing. So before we climb in, just real quick, I'm going to try and be brief about this and just get into it because we got a lot to cover. But please do me a favor if you haven't done so yet. Well, first of all, welcome to BitBreak Live. My name's Keith Allen. I'm a full-time trader. I'm a work-from-home dad, and I am co-founder of Material Indicators. Do me a favor, if you will, smash some buttons, help me grow the channel, especially hit that share button and invite somebody into the stream, whether it's a trading buddy or a community that you trade with or engage with. Invite those folks into the stream, and do yourself the favor of hitting the subscribe button so you don't miss any of the future streams, because I drop the free alpha on the regular here, and you don't want to miss out on that. So let's just climb right into what I have been talking about. Oh, and by the way, live chat is open. Would love to have you engage with me here. We got a lot to cover, so if you have some questions, I'll do my best to answer them. If you have insights, please share them. We're all in here learning together. So I want to start by sharing a candle chart, and I'll speak to it as we get into this thing and tell you exactly what I've been seeing here in the market and in the price action and in the sentiment. So I went away for a nice holiday weekend with my family, just a quick one to go see some family a few hours away. And so didn't do much in the way of trading over the weekend. But obviously kept an eye on things. And the one level I was watching was, of course, the Yearly Open, which, we lost that obviously quite a few times already, and have tested to try and break back in it a few times. But what gave a glimmer of hopium, if you will, and I should preface this by saying, and it's well documented, that I have stated that we're in a confirmed bear market. Saw that since the monthly close. But we did get a close on Sunday night above this green 21-day moving average. And this was important for a lot of reasons. It gave us the opportunity to do exactly what happened today, which was go back and test resistance at the Yearly Open Timescape. Now, the timing of this, there's a lot of things that you could read into this, and I guess I should lean on my written analysis here and talk a little bit about how we got here and why price action is doing what it's been doing here for the past several weeks. There's a lot of how should I say, mixed sentiment on the market. And one side, you have the narrative traders clinging on to talking points rather than the data. They're saying macro is too bullish for a Bitcoin bear market. A Fed rate cut is going to ignite an immediate recovery, or Michael Saylor's next buy is going to save the trend. That's a no, and a no way. Okay. So yes, we did see some price action today, push above that 2025 open. And yes, this close above this 21-day moving average kept us in the range here, right? It put us in the zone, and we're still in the zone here, right? We've wicked up above it, and we've been rejected again. I'll get into that in a moment. But do you think it's coincidental that this happened today? We have a Fed rate cut scheduled for tomorrow. It is not 100% baked in, but it is 89% baked in. Let's see if this has even gone up in the last bit. Oh, now it's down to 87% baked in. It's baked. It's safe to say a quarter point is baked in at this point. And so this rate cut in itself, in and of itself, is not going to be the catalyst that moves the market. Okay, because it's baked in. We already know it's here. It's happening. Powell's comments could give us some additional volatility. His outlook could give us some additional volatility for sure. But the rate cut itself is baked in. But the reason I say that today's price action was expected is because every time we get around these Fed days, these rate cut decision days, we see some volatility like this. And we could see it unfolding. We can actually see it developing in the order book on fire charts before it actually happened. Um, look at all of this stuff here, right? There's a lot of liquidity moving around that may or may not necessarily have an intention of getting filled. And I posted something the other day just about this one specifically. And not, I said this is likely to spoof, and sure enough, first it stepped down and it spoofed. Right, no intention of getting filled. It was here to try and push price, which it did. Right, it showed up here, price went up, it dropped, and price dropped, and then it rugged, and price came down further. But fortunately, price stayed above that 21-day moving average to keep it within the range of this yearly open timescape. And we reclaim that today briefly with a nice little squeeze above up to 94.6K. And I was thinking we might even hold above this longer than we did. We didn't, obviously, but that doesn't mean it's over. Doesn't mean that this rally is over. And the fact that we now have the 50-day moving average coming into confluence with this next timescape from the first week of the yearly open, first week of Q1 actually, we see a strengthening of technical resistance here at this level. So trying to play out scenarios of how things might develop here in the coming days, in the coming weeks, et cetera, et cetera. You have to look at the technicals, obviously. You have to look at the data. That's the number one thing. You have to look at the order flow. You have to look at the liquidity movement in the order book and how much is there. But you also, I find it helpful anyways, to factor in just some of the psychology of the market. Some of the, and I'm not speaking specifically of the Wall Street cheat sheet psychology, but I guess we could look at that too if you want. I actually had that up the other day. Do I have it open? I don't. Let's see if I can go find one real quick. But I'm speaking of the psychology of how this market likes to flow. Wall Street cheat sheet. There it is. Okay, let's just grab one of these real quick and see if we can expand on it. So where do you think we are in this whole, what is it, 14 phases? Where do you think we are in this? I've got a pretty good idea of where we are. I'd be interested to know what you guys think. If anybody wants to chime in, those comments are open. There's obviously some mixed sentiment going on in the market right now, but I think that, and I'm going to show you, I'm going to lay this over lay a chart over this here in a second, and we can analyze it further. But I think that we are transitioning from the anxiety into the denial phase, and then what comes next, right? Panic, capitulation, et cetera, et cetera. So the good news is it means we're getting closer to marking a bottom. The bad news is we're not there yet. So why do I say we're in this phase? So notice here we have this, you have your euphoria, you have your top, you have a rally, and then you have a cascade, and then you have another little rally here, little distribution rally, and then we move into that denial phase. So let's look at this guy right here. We have and I'm going to turn the timescapes off and make it a little bit cleaner for you. We have our euphoria stage here where we hit that all-time high, and we had that relief rally, and then we have the cascade, and now we have another little relief rally, which to me feels like we are in this kind of area right here. So somewhere between anxiety and denial. And maybe that denial is going to get punctuated tomorrow with a Fed rate cut, and how the price action is going to recover. So people go, oh, rate cut means price is going to go up. Well, it doesn't necessarily mean price is going to go up, especially when you factor in the reason for the cut. And the data has been skewed at best. The Fed does not have all the current data because of the government shutdown. So what are they going to be acting on? Well, they're acting on limited data, and I guess they're likely willing to take the bet that that the data is going to support a cut, quarter point, and we will get additional data. But even this is, a lot of this is still delayed. So we'll be waiting for more. And then, by first of the year, we will of course be getting another set of information that at that point I think will be current. And then what's that going to mean, right? So how many more opportunities for rate cuts are there? Well, there's a meeting at the end of January, and then we have a meeting in the middle of March. You know that Fed Chair Powell's last day is in March. I'm not sure what his last day is, but his term ends in March. And so, we'll have to see how things move from there. But after Powell is replaced, he's going to be replaced with a guy who's going to do whatever President Trump wants him to do, which means cut, cut, cut. So there's likely more cuts coming. And that may or may not be good for the economy. We'll see what's happening at that point. So that's kind of the whole cut psychology. But we get into these situations where people think, okay, there's going to be a cut, and then they don't get the pump. Well, we often see this kind of move right here, where the range is cleared out, right? The days up leading up to an event like this, we see the range cleared out, and this makes way for volatility, right? Now that we've cleared all this out, and unless more bid liquidity comes in, it's an easy drop back down here to the mid 80s. And doesn't mean it's going to happen, but we need to see more bids come in to hold things up. So what's here now? Not a lot, right? This is just $4 million here at 91 at 91K. And here's another 3.5 million. So we need to see some bright bands, brighter colors equaling more liquidity in this range to keep price elevated. And at the moment, you can see it's a little bit more concentrated up top, but not a huge amount. 16.5 million here at 94K. So nothing is off limits. Nothing is unattainable, I should say, at this stage. So in terms of what it takes to validate invalidate the bear market or validate a return to the bull, those things are well documented and pretty simple. We've talked about this quite a bit. We have the 50-week moving average would be a key thing, right? And so you don't get there without running through these other levels, right? We obviously, to get to the 50-week moving average, we would obviously need to reclaim the yearly open timescape level, which we did briefly today, and we've lost it. We would then need to reclaim this timescape level from January 6th, and then ultimately up here on the 50-week moving average, which currently sits just above 102K. Some sentiment in our Telegram group for 107K as a possibility, not for reclaiming the market per se, but for this move. And that would be the mother of all squeezes. That would really shake out a lot of people, because it is widely believed that price needs needs to reclaim this 50-week moving average to be back in the bull. Doing so would trigger some algos for sure. Not only would it squeeze some shorts, but it would have a lot of bears scratching their heads, which is why I say it's important to wait for weekly closes. You're looking at a weekly metric, you got to wait for the weekly close. So even in this instance, a wick above doesn't mean anything. It's where do we close? Where do we close? And so far, we're not on pace to close above that level. Maybe we reclaim it before the end of the day. We'll see. And if we do, maybe that bodes well for another push up. But gosh, imagine a move to 107 would really, really punish a lot of people on both sides of the sentiment equation. So this is the line I've been looking at. So this is one component, one element, if you will, of a recovery. So weekly close above the weekly, above the 50-week moving average. And the other thing that I need to see is a weekly close above this 41 level on the RSI down here. Let's see if I can expand this real quick. And look, we're nosing right up to it again today, but not quite, right? We've seen it. If you've been watching it, I've seen it wick up into it and then retreat, wick up into it and then retreat. So we're in the right zone, but again, it's not how you start, it's how you finish. Weekly closes above this, combined with a weekly close above the 50-week moving average, is what I need to see to invalidate the bear market and say that the bull is back. Now, if we don't get that, where might we be going from here? And if you haven't seen this metric here, by the way, I encourage you to lay it across your chart on the weekly RSI and notice how the how price action relates or correlates to those downtrends. Is this not? There it is. Notice how price correlates to that, right? So every time we're down below this 41.5 level, we are in a confirmed bear market, okay? Right here, short-lived on the COVID crash. We wish this could be short-lived, right? Here it is back in 2018, confirmed, down to the bottom, boom, and then back up. So this has happened every single time that the weekly RSI has been down below this level. We have been in a confirmed bearish downtrend, bear market, call it what you want. It's price go down. That's what it is. That's what it means. And so now what keeps us from going down further? Potentially, and if we did, how far could we go? Well, for that, let's go back to this chart. Obviously, being able to reclaim this yearly open would be a positive thing, right? Every level that we reclaim up keeps us from going down, right? And likewise, every level of resistance becomes a problem. So in terms of where we could go from here and what you need to be watching, obviously you need to be watching whether or not we can reclaim this yearly open. If we cannot, then can we hold on to this trend line? And my thought is probably not. If we can't hold this, we're probably not going to hold this. So then your next line here, we go back and retest support here at the 21-day moving average. And that one's pretty critical at this point, because if we lose it, we go, what's the next level to test? Well, the next level to test from there is this trend line. And that's it. That's currently at about 86.5. So, and we do have a series of higher lows here. What we want to prevent, or what we don't want to see, if we want bullishness, if we want a bullish recovery, we don't want to see lower lows. And here's how things start to translate if we do indeed break it. So to the downside, I guess, this 86.5 is really a critical support level, because if we don't hold it, there's a real good chance we're making a lower low. And where are the lower lows from here? Well, obviously our near range, we had that dip down to 80.5K. I don't see a lot of argument for saying that would hold as support. Again, if we go back down to this level, yes, there's a little bit of confluence here. And let's see if there's any more, actually. Um, Not a lot, right? There's obviously nothing prior to that because we hadn't broken above 69K. And if you recall, if you've been with me for a while and you recall when we were on this the November Trump pump and we were making these straight lines, I kept saying, hey, we got to have some consolidation. We need to have some consolidation to form some structure for the pullback or the bear market when it comes. And the longer we consolidate in any range, the more structural integrity it has. So, for example, this low right here, this actually was caught by some confluence we had here, dating all the way back to November of 2024, and we had a little bit more, obviously, in this range here. So that's why this wasn't just a random place to stop. It stopped because there was some structural, not a lot, but some structural integrity there. Now, where's the next level? And I had talked about this when we first started doing these death crosses, especially the death cross between the 50 and the 200, which was followed pretty quickly by the 100 and 200 death cross. But we're all wound up here in a bearish crosses among all of these moving averages. And a lot of times it will be double bottoms that end up as the landing zone. So there's a lot of sentiment for 75K. And I would agree with that as a potential landing zone. Whether it's strong enough to hold depends largely on the timing of what is happening at that time, what other fundamental factors may be influencing price. But I noticed something when I was putting this chart together, and this is a fresh chart I put together yesterday. I'm not one much for conspiracy theories, and I'm going to chalk this up to a quant with a sense of humor. But look exactly where this level is, this price level, this lower low, this and hey, maybe it's a quant with a sense of humor, or maybe he's sending a message. And this landed precisely at 74,420 and 69 cents. And we know this market, the crypto bros think 420 and 69 are funny numbers. And, that's why that we see them, mentioned a lot. But that's pretty interesting to me. So a humorous reason to give this more maybe a little bit more value, but really there is technical merit on this level here at the 74.4K range. If you lose that, and this is an area that I have a lot of confidence in, yes, this could potentially hold, but I feel like if we go this low, we're awfully close to that yearly open. And when we talk about the 2021 top, and we talk about this, we've heard people throw out that 70K number a lot. 70K, 70K, 70K. When are we going to break it, right? This was all the way back to, February of 2024, February and March. The level is actually 69K, dead nuts even at 69K. That was the 2021 top. And there's that 69 again, right? Dead nuts to the top. And so if we don't hold on to that 74.4K level, I've got eyes on 69K. And the reason I like this level is because we spent, not only because it was the 2021 top, but because we spent so much time consolidating here. This to me is the strongest foundational support in the chart, because we spent so much time consolidating here. And it wasn't until the election day Trump pump that we actually broke it sustainably. And so I've drawn some other lines here on the chart. Not that I think that these are necessarily prime targets, but with each level you lose, you have to identify where you could go from there. So this is my scenario on where the key support levels are if you're looking for ranges to dollar cost average, which I'm doing, and incidentally, somebody asked me what I was doing with my position. Am I sidelined? No, I'm not sidelined. I'm definitely not sidelined. I have leaned up my Bitcoin position, and I leaned up a little bit more today on the pump, and that's what I'm trying to do. I'm trying to lean up on pumps rather than dumps, and I'm trying to buy on dumps. And so, if we are indeed here on the chart, then I believe that there is a significant amount of downside ahead of us. And so I am not rushing to buy just yet, but I do want to, and I do have some bids at some key levels. Not that I think it's good to catch knives, but I do want to. I think there's some prices that are bargains, and so yes, I do have some bids stacked here at 69K. But if we lose that, then people are going to say, "Oh, well, 50." How many people have you heard or read on social media say, "We'll never go to 50K again. We'll never buy Bitcoin." I mean, they said the same thing about 100K. We'll never buy it below 100K again. Bullshit. Okay, you can't say that. Well, you could say it, but it won't be true. So I make it a rule to never say never, except for when I'm saying never say never. Um, so you can't rule out any scenario. And so, do I think that these are high probability targets? No, I do not. Do I think that they are all viable and legitimate targets? Absolutely, I do. And what would they mean? What would that translate to in terms of drawdown from an all-time high? Well, where we sit so far, I mean, we're already at 36%, and that's commonplace. That's nothing in crypto. If we were to go to make that lower low at that 74, 420, 69 level, that gets us to about 41%. If we get down to that 2021 top at 69K, that's 45%. Prior bear markets, I will tell you, have gone much, much deeper than that, like over 80% in some cases. And so even a trip to 49K would be 61%. So what's that 80% number look like? Well, I mean, getting all the way down to sub 30K gets us in the range of where this, in my opinion, where this cycle's bull run really was confirmed, right? You could argue that, oh my gosh, and look at this, all the way down, a full retrace to the FTX crash would be 88%. And I'll show you why that's interesting here in a second. I don't think that's a likely target, by the way, but my goodness, that would be talk about a generational opportunity. I started dollar cost averaging my position from here, and and I thought these were all bear market rallies, to be honest, at that time. So from November of 2022 through June of 2023, June of 2023, I was like, yeah, I don't know. I don't know. I think these are bear market rallies. And then we got that confirmation, right? So we came back down to 25K. I was feeling good about my bear market rally theory. And then we broke to the upside. And that break to the upside was marked with golden crosses, unwinding of the key moving averages, right? They were all wound up here. And then they unwound the green 21, started golden crossing everything, and everything else followed. And so this was the indication, this was the confirmation for me that the bull market had begun. And that was in that 25 to 28K range where we had all this consolidation. And then, the rest is history. So these are targets you might think about. Again, I don't think that going all the way down here is a high probability at this point, but I'm not going to rule it out. And I'm going to show you why I'm not going to rule it out. Let's go to this chart. And I think I have these listed. Let's see. And one here, maybe. Okay. So let's look at the prior bear markets and see where price has gone. See what Bearadise has looked like in prior cycles. 75% back in 2011, 86% back in 2014, 83, 84% in this is 2018, 77% in 2021, 2022. So it is not outlandish to say that that's a possibility. You can't rule it out. Again, I don't think it's a high probability, but it's not something that I rule out completely. So that's my take on it. Let's see. Some jerk named Bob. Definitely get appearance of being at anxiety level, but I really can't shake the feeling that we haven't hit euphoria yet. Well, you might feel that way, and it's okay to feel that way, but I hope you don't feel that way all the way down to the bottom. And I would just say this. This is why we don't speculate and why we don't cling on to narratives. It's why we just look at the charts, because the charts are going to tell you the truth. The charts don't lie. So when we have all these confirmations that the technicals, and this goes back to what I said, Bob, this goes back to what I said at the beginning of the stream, if you missed it, which is we have one side of this market, the narrative traders that are clinging on to the talking points, and they're clinging on to the talking points rather than the data, and that is at the expense of their portfolio. So be mindful of that and resist the urge to speculate. And when in doubt, let the charts be your guide. And loving the stream. Glad you could catch it. I'm glad you caught it too, man. And I hope you will subscribe and so you don't miss any of the future ones. Appreciate you being with us. So that's basically it in a nutshell. And these targets that I just shared with you, I want to go ahead and turn on timescapes and see if we can add any technical value or strength, I should say, to those levels that we discussed. And in my opinion, anywhere that we see a concentration of timescape levels, we at that point have more strength. And so you can see we have obviously timescape levels around all of these levels up here, but they're pretty much singles and doubles. And as we get lower, especially around this, where's that 74? So actually no real timescapes around this lower low, the old 74 420 69 thing, right? The Q2 timescapes, it's really in between the Q2 timescapes, the April 1st and the April 7th, which was the first week of second quarter. So yeah, it's between there. That doesn't give this any additional strength, in my opinion. They're a little bit, out of the range. But as we go lower down to this 49 level, look at this concentration of timescapes we have in here. This to me makes for very strong support. There's a lot of sentiment that we would stay above 50K. That's just enough reason to flush through 50K. Just in terms of how this market psychologically operates and how it likes to fuck with people and algos. So that's certainly one I don't rule out. And then again, what was my other target down here in this 28, 29 range? A nice cluster of timescapes around here. Add some strength to this level. So that's what I'm looking at. I think it's a very low probability that we go all the way down here, 87%, 88% down to 15K. That would just be astonishing to me. And it would, I think it would, I mean, what we're doing now is flushing a lot of the market, which needs to happen. Banks are coming online as we speak. And I discussed this months and months and months ago when the Genius Bill was signed, that I expected to see a flush of the market as they came on board or before they came on board. And that's happening. So This is all timing out really as expected. We have, and not that I want to sprinkle too many narratives in here because I just said let's not cling on to narratives. Let's look at the charts. But if you're thinking in terms of how long this could last, bear markets historically last, about a year, maybe a little more. Doesn't mean that this one has to last the same period of time. But I would say this. This one actually began, the downtrend began back in October. Midterm elections coming up in 2026 would be around that time, right? October, November. And, well, the election would be in November. But that Trump is going to want to do everything he can to have the market soaring when those elections come up. So there's that. Not that he's up for election, but his party is. Many members of his party will be. So that correlates with that 12, 13 months from when this downtrend began would be on par with prior bear markets and prior cycles. So there's that to consider. In the meantime, I just let the charts tell me what to do. And as we move forward from here, I'm going to ask you to do the same. Here's all you need to know is happening right here around this triangle. If tomorrow we move back above this yearly open, which I will not be surprised in the least bit if we do. I won't be surprised in the least bit if we come up here to this 98.3K level. I won't be surprised even if we come up all the way up to 102K and flush through this and maybe even squeeze that one a bit. Any of it is possible. But until we get those scenarios, which are weekly closes above the 50-week moving average and the RSI, weekly RSI above, closing above this 41.5 level, we're not there. So both of those things have to happen for me to call this a bear market invalidator and a return to the bull. Until then, watch this very, very closely. And if we lose this, like I'm expecting volatility tomorrow, and then I'm expecting it to dump. Again, I preface this by saying hitting these targets up here, these weeklies, aren't off the table. I actually do expect it to happen at some point in time. I don't know if it will. And if we lose this, if we can stay above this yearly open, if we can close above the yearly open, then we have a shot at doing that. And if we don't, obviously, all bets are off on that deal. So keep an eye on that. And again, if we break down through this structure here, which actually has some confluence with the 100-week moving average now that I look at it, if we break through this, then know that those downside targets that I just shared with you could be coming into play. And you pick the ones that work for you. I would caution you against knife catching and instead wait for buying to resume or use a tool like the MTF mean reversion indicator, which you can set for any level of volatility that you want. You could use it to scalp, or if you want to use it to buy bigger dips, then set your deviation deeper, and you can pick up incremental bits and just dollar cost your way down. That's the simplest way I know how to do it. Simplest and safest way to know how to do it. Hey, thanks, Bob. I really, really appreciate it. He says he appreciates the rational discussion and solid analysis. Thanks, man. Hey, you don't know how much I appreciate that. It really means a lot to me. So thank you. Gonna leave it right there, guys. If you haven't done so yet, do yourself a favor and join our Telegram communities. Links to that are in the description below. Oh, yeah. And you want access to these tools? Guess what? All of them on sale right now at Material Indicators, 33% off, and a very special deal for the holidays. Check this out. So a lot of the tools that I've showed you here, especially Fire Charts 2.0 and the Timescape Levels indicator, these and many, many others are exclusively available in Premium Plus plans. And up until now, up until this holiday sale, the shortest duration you could get Premium Plus was a year. And just as a gift to you guys, like one of the most common requests I get is, hey, can we get Premium Plus for like a shorter duration? So I did this just for you. 3-month Premium Plus. There it is. 3-month Premium Plus at 33% off. And if you have an active subscription and you want to upgrade, we'll prorate the value of what you already have. So that reduces your cost even further. And get this, doesn't matter what plan you buy. 33% off from monthlies to 3 months, 6 month, annual, lifetime. Everything is 33% off. And if you're new or you're upgrading to a new plan like Premium Plus, 14-day money back guarantee. I'm so confident that this data and these charts are going to help you trade smarter. If they don't, all you got to do is ping me on the Telegram or send me an email or hit me up on X and say, Keith, I tried it. It wasn't for me. And I'll refund your money. 100%. No questions asked. All right. So there you go. The deal could not be better. Links are in the description. Link to that Telegram community. The Telegram community is free. Join us there. Make sure you're doing that so you're in the discussions and we're engaging on the regular. And until we do it again, I hope this helps you trade smarter.